Welcome back, investors. Jake here. In this video, let's talk about a position I've taken in my Schwab account in Apple, and on my channel about 5 weeks ago, I made this video, Apple's stock price to 200, buying long calls example on Apple, and obviously I'm an Apple fanboy. I think it's a fantastic company, but this was a technical play. Apple reached about 143 a share back in January, and the stock price didn't move through October. Through October, 10 months, it was down about 2%, while the S&P 500 was up 23–24%. However, in the last 2 weeks, Apple's share price has taken off, basically up 18% in 2 weeks since I made that video. Now, this is good news if you're an index fund holder, because Apple is basically part of almost every index fund. So this is good news for the market, good news for everyone, but especially good news for me because I've taken a leveraged position in Apple. When it was below 150, I bought 3 call contracts with a strike of 150 with an expiration date far out in the future of January of 2023. My cost basis for these 3 contracts was $5,500, and I'm currently up 106% on my cost basis. This is the power of options, guys. So I'm up $5,953. The total value of these 3 contracts is $11,550. So Apple is currently at 175. I don't see it stopping here. It's going to get at least to 180, more likely 190, potentially 200. I don't see it going above 200. 200 will probably be its new line of resistance, and it's going to bounce off of it. So in this video, let's talk about what is my plan. We'll review the technicals for Apple, and we'll talk about what am I planning on doing with these 3 call contracts if they don't expire for another 12 months. But before we get into that, let me just quick mention 2 of my other positions. The first one being General Dynamics, which is a defense contractor. And there's a lot of news articles coming out this week about how Russia has amassed 120,000 troops on its border with Ukraine, and reports are saying they're looking to invade the Ukraine in late January or early February. So if you're not familiar with the geography of the region, 5 or 6 years ago, Russia already seized Crimea down here, which belonged to the Ukraine. The United States put sanctions on them, but there basically wasn't any other consequences. So over these last 4 years, Russia has been building up on the border. And the theory is that they're looking to take basically everything east of this river. This river runs through Ukraine, and it's the Dnieper River. I don't know if I'm saying that correctly. But, geographically, Russia's saying that's a good cutoff point for basically what should belong to us, and then what will allow the Ukraine to keep. Will this or will this not happen? I don't know. But in the meantime, a short-term play that traders might make is defense contractors. If Russia does invade the Ukraine, obviously the market will have a panic and a sell-off, but short-term traders are probably going to flood to the defense stocks, and I think General Dynamics is the best one. So just wanted to mention that to you. There's also the situation with China and Taiwan, but I think the Russia-Ukraine is the more immediate threat. The other position I want to highlight for you guys in my account is Berkshire Hathaway, which basically hasn't moved in the last 2 weeks. So think about this. Apple's share price has gone up 18% in the last 2 weeks, and Berkshire is basically flat. Does this make sense if I were to tell you that 42% of Warren Buffett's portfolio holdings are in Apple? He owns 887 million shares worth $125 billion. So if Apple has gone up 18% in 2 weeks, then these 887 million shares that Warren Buffett owns has also gone up 18%. But Berkshire's share price hasn't moved, meaning the market hasn't priced in the gains that Berkshire as a holding company has made yet. So if you're kicking yourself that you didn't buy Apple when it was below 150, you can buy Berkshire right here at 283. That's a steal. Now, Berkshire is not going to give its fourth quarter earnings statement until February, but they're obviously going to report all those gains they're going to make in Apple, and eventually, I think, later this month or in January, Wall Street will eventually be like, Oh yeah, Apple went up huge and Berkshire owns a ton of it. So this is going to get through this line of resistance at 290. Where's Berkshire going to go? And I'm hoping it gets at least to 320 or 330. So that's a price mismatch happening right now. And based on the technicals alone, I thought Berkshire should have gone up. But now I'm more confident than ever that this is going to shoot up in the next 2 months. So I'm filming this video on Thursday, and we've had 3 consecutive green days in a row in the market. This is obviously helped by Apple's share price basically taking off. And it's funny because if you just go back a week to December 2nd, there was headline articles like this: Apple's shares fall on fears iPhone demand is weakening for the holidays. Basically, there was a rumor that suppliers were told by Apple, we don't need any more of your parts or components because demand for our products isn't as high. Apple came out and said, nope, that's not true. Demand is good as ever. I think probably suppliers have also come out and said this rumor wasn't true. So here we are a week later, and we've got a headline here, December 7th, Morgan Stanley hikes Apple's price target, seeing a 21% upside from plans for smart glasses and the self-driving car. I mentioned Apple's car, the rumors. That's not going to be a thing, guys, until 2025 or 2026. However, Apple producing and making their own VR or virtual reality or augmented reality glasses, this is something they could have out to the public by 2023 if they really dedicated the people and the capital. And I'll be honest, guys, I have the Oculus Quest 2. I love this device. I love the service. I think it's a lot of fun. But the thing I dislike the most about it is that Facebook owns Oculus. Zuckerberg owns this product. So the second that Apple makes their own VR headset, I will be one of those people, lining up to get it on day one. Because I have no loyalty to Oculus or to Meta, as they're calling themselves now. So let's recap Apple's technicals, and I'll just show you what I've been seeing. Let's change this to candlesticks, and let's show you, going back to January 26, we hit a line of resistance here at 145, and this was a line of support, line of resistance going back 11 months. It did briefly dip down to 140, would have been a great buying opportunity. And there was a very strong consolidation range around this nice even number of 150. However, the most recent line of resistance here was at 155. So as soon as it got above 155, basically there's no sellers anymore. The large funds will set sell limits at nice round numbers, meaning that if Apple gets to 155, they're trying to sell potentially billions of dollars worth of shares because they think it's overvalued. They want to reallocate that capital to other positions. So when it gets, clearly above 155, well, who's selling now? Where are the large funds putting their sell limits? And if everybody, is on the same page here and they say, well, maybe another nice round number would be $200 a share, I'll put my sell limit, at 198 or 197 just before everybody else, then it's just going to take off. It's just going to melt up. This is what happened to Tesla back in October. It got above this line of resistance basically at 900, and it just exploded to 1250 because there weren't any sellers. Nobody was willing to sell, and people still wanted to buy. Same thing happened with Nvidia in late October, early November. It got above this line of resistance at 220, and it just melted up until 300, and it's entered this new range of consolidation. Same thing with Tesla. A range of consolidation is between 1,000 and 1,250. So Apple is now doing exactly what Tesla and Nvidia did 2 months ago. So the fact that we've had recent prominent examples, I think, once again, everybody's in on it now, and they know that they can walk this up now to 200 before it'll start channeling sideways again. For indicators, let's add the moving averages, and I cannot stress this enough for you guys that with these large cap stocks, they just act very predictably. So this red line is the 200-day moving average, and as soon as the 200-day moving average caught up to Apple's share price at 123, this was back in June, look at this bull run it went on up to 150. It went from 123 to 150, basically 3 consecutive weeks of green days to get back above that 200-day moving average. Now, when I entered this position, the 200-day was catching up, and I was thinking to myself, okay, it's going to need maybe another month or two, but I'll just go ahead and enter my position now. So Apple is taking off before when I thought it would, and as soon as it starts channeling sideways, it's going to wait for this 200-day moving average to catch up in 6, 9, 12 months from now. The question now becomes, what do I do with these 3 call contracts that I bought that are currently up 106%? It's very tempting to just immediately take nice gains once you have them. However, you need to have a game plan, an exit plan for what you want to do with your positions, especially leveraged positions. So with the strike of 150, these call contracts are now deep in the money. And I see Apple getting to a nice round number, probably 190 before it starts channeling sideways again. So if it's going to 190, there's no way I'm doing anything with this position before then. But once it's shown that it's hit a line of resistance and it starts channeling sideways, I have 3 options, 3 plan of attacks basically. The first one is the easiest one, the most obvious one, is I can just sell to close this. With options, when you buy to open calls or puts, you can sell to close them for a profit or loss at any time. Nobody ever has to hold these until expiration. So that's option 1, just take my profit and move on to the next stock. The second one is to basically sell a call against the calls that I've bought with the same expiration. Now, I might be getting too technical. When I actually do make these trades, I'll break it down for you guys more in detail. I know not everybody watching these videos is too confident with their options background here. But when the share price hits 190, I can sell a call against these calls, maybe with a strike of 200, basically a nice round number where I don't think Apple will get above it. And I can start collecting premium from those contracts wasting away. What I've done, in effect, is created an in-the-money, credit spread, because my cost basis for buying these was $5,500. The market value is $11,500. So if I were to sell calls against them with a higher strike, basically I just want to get above my cost basis, and it becomes a risk-free spread. Once I cap it, with selling a call, this is getting very technical, guys, but if I sell a call at 200, once Apple's reached 200, I receive a payment that is greater than my cost basis for the shares that I bought. So in a way, I can't ever lose money on this position. I can still gain a little bit more as extrinsic value converts to intrinsic value over time. Additionally, I'm just betting that Apple won't go above 200. But yeah, I mean, it's tempting basically to convert this into a risk-free spread. I will show you how to do that if I do that. The other option is when Apple's share price reaches 190, I can start selling monthly calls against these calls. They're not naked calls because obviously I hold calls that are deep in the money. If you're familiar with leaps or the poor man's covered call, that's effectively what I'd be doing. So I have deep in the money calls that I purchased that went up in value. I don't know what the delta will be, but the delta is irrelevant because my cost basis for these contracts was so low. So if Apple reaches 190 and starts trading sideways, I'll start selling monthly calls against them with a strike of 200, earning pretty decent premium. I don't know what the premium will be, but I'm guessing it'll be probably around $600. And if I can do that 3 times a month, I mean, I'll be making close to $2,000 a month selling calls against my leaps. They weren't originally leaps when I bought them, but they became leaps through price movement. But I mean, if I can just start selling calls against them and make close to $2,000 a month, and it's risk-free. You know, if Apple's share price takes off, these also go up in value. The calls that I sold will be in the money. It will trigger on expiration after the 1-month contracts. Those will trigger and I'll lose these calls. But once again, at that point, I just can't lose money on this trade. Okay, guys, I definitely was rambling a little bit there, talking about my options plays for these Apple contracts. I'll make a more detailed video explaining these possibilities in the future when Apple does get closer to 190 or 200. If you guys like these kinds of videos, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.